Ovintiv just dropped their Q2 2026 numbers, and they completely blew past the high end of their production guidance. We're looking at a massive beat today.
Yeah, they hit 615,000 barrels of oil equivalent a day, which is, just a staggering volume for a single quarter.
And we are skipping the pleasantries today because we need to unpack this cash engine for you right away. In this deep dive, we're looking at a company that generated $1.6 billion in operating cash flow in just 3 months.
Right, but the number investors really need to zero in on is that 682 million in non-GAAP free cash flow. That's the metric that actually matters here.
Exactly. Because
Yeah,
net income, that includes all sorts of paper accounting measures. Things like depreciation on their older assets.
yeah, free cash flow is the actual tangible cash left sitting on the table after they've paid for all their operating expenses, taxes, interest, and crucially, after they've fully funded their capital expenditures.
Right, because they didn't skimp on investments either.
No, they didn't. They spent $574 million on capital investments this quarter, drilling new wells, maintaining infrastructure.
Yeah.
So that $682 million is purely unencumbered cash. Every single bill and reinvestment has been paid.
Generating over $500 million in pure free cash in just 90 days gives a management team immense strategic leverage. But, the mystery really deepens when you look at their forward-looking guidance.
It does. It's probably the most interesting part of the entire report.
Because they revised their full-year 2026 production guidance upward. They're now expecting 630,000 to 645,000 barrels of oil equivalent per day. Yet, and this is the crazy part, their expected capital investment for the entire year remains exactly the same.
Perfectly flat.
Yeah, it's pinned at 2.25 to 2.35 billion dollars. It's like imagine a factory where management tunes the dials so perfectly that the machines just start producing way more widgets, but you don't have to spend a single extra dollar on maintenance or electricity.
Right. And what's fascinating here is that raising production guidance without raising your capital spend is basically the absolute gold standard in the energy sector.
Because usually it's a completely linear relationship, right?
Exactly. The traditional math in oil and gas is if you want more barrels, you have to drill more wells. And drilling more wells requires more capital.
More rigs, more steel, more labor.
Yeah, all of it. But Ovintiv is demonstrating that their underlying asset base is heavily outperforming those baseline expectations. They're getting more resource out of the dirt for the exact same dollar spent.
But paper math and headline numbers only mask reality for so long. To understand how this engine is running so efficiently, we have to look at what they're actually holding in their portfolio.
Right, because you can't out-engineer bad rock. Rigorously curating the assets you choose to operate is the only way to achieve this kind of capital efficiency.
And they completely overhauled those assets this year. Back in Q1, they bought New Vista Energy for about $2.8 billion.
Which was a massive strategic move. That acquisition gave them premium assets in the Alberta Montney play.
And that added, 930 net well locations?
Yep, 930 locations and 140,000 net acres. And for those who don't track Canadian geology closely, the Montney Formation is world-class rock.
What makes it so premium, geologically speaking?
Well, it's highly overpressured and it's incredibly thick. That geological thickness allows for what the industry calls stacked pay.
Which means they can drill multiple horizontal layers in the exact same vertical footprint.
Exactly. You drill one vertical hole, but you can branch out horizontally at several different depths. So they basically bought a massive runway of high-margin, long-term inventory in a region they already understand deeply.
Okay, so that was Q1. But then in Q2, they turned around and closed the sale of their Anadarko Basin assets down in Oklahoma for $2.82 billion in cash.
Right, so they effectively swapped a $2.8 billion asset for another $2.8 billion asset.
But wait, I have to push back on the math there. I was looking through the filing, and they actually took a $337 million pre-tax paper loss on that Anadarko divestiture.
It did, yeah.
So why would a management team voluntarily sell an asset and take a massive loss on it? Is this just moving deck chairs around on the Titanic, or is there a bigger strategy here?
It's textbook portfolio optimization. And honestly, it takes a lot of discipline to absorb a short-term optical hit for a long-term structural gain. The Anadarko assets were older, they were higher on the cost curve.
So they were basically more expensive to operate?
Exactly. So they swapped those older assets for the Montney assets to concentrate entirely on high-return premium inventory. But The real structural win is how they deployed the cash from that Anadarko sale,
Right, they didn't just sit on that $2.8 billion. They used it to immediately retire $700 million in senior notes that were due in 2028.
which is huge for the balance sheet.
It is. Let me translate that into the real-world impact for you. By eliminating that specific chunk of debt early, they instantly wiped out $40 million a year in annualized interest payments.
$40 million in hard cash that was just vanishing, going to bondholders every single year, is now staying inside the company.
That's incredible.
It really is. They swapped a lower margin, higher maintenance asset for a higher margin asset and simultaneously cleaned up their balance sheet, absorbing a paper accounting loss to permanently eliminate $40 million in recurring annual debt interest. That's a highly calculated win.
Okay, so with a leaner portfolio, higher margins, and significantly less debt interest to pay, the natural next question is, where does all that $682 million in Q2 free cash actually go?
Right to the shareholders.
Yeah, the answer leads directly to the investors. Ovintiv returned 63% of their Q2 free cash flow to shareholders.
Which is an incredibly aggressive capital return framework.
It totals $429 million in a single quarter, and $345 million of that went directly into share buybacks. They retired about 6.1 million shares of common stock.
And the remaining $84 million went out as base dividends.
Right. And their overarching framework commits to returning anywhere between 50 and 100% of their annual free cash flow.
Yeah, and because the first half of the year has been so efficient, they actually just raised their full-year expectation.
For 2026.
Exactly. They now expect to return more than 60% of free cash flow for the full year, which is a significant bump from the 45% they were tracking at year-to-date.
So what does this all mean for you as an investor? In their presentation materials, the company literally states that they see a, quote, meaningful gap to intrinsic value in their share.
Yeah, they think the market has them priced totally wrong.
If they are taking $345 million in a quarter to buy back 6 million of their own shares, is that the ultimate sign of a management team putting their money where their mouth is?
Oh, without a doubt. They are broadcasting loudly that the best possible investment they can make right now is simply buying themselves. But, a company can only execute buybacks at that kind of scale if their balance sheet is completely bulletproof.
Which ties directly back to that Anadarko sale and the debt reduction. Let's actually look at the balance sheet numbers.
Let's do it.
The report says their net debt is sitting at $2.995 billion. Now, $3 billion sounds like a massive burden in a vacuum, but then they provide this leverage ratio. Net debt to adjusted EBITDA is 0.6x.
Right.
Let me try to break that down, and you tell me if I'm totally off base here.
Go for it.
Adjusted EBITDA is essentially a proxy for the core cash engine of the business, right? Earnings before interest, taxes, depreciation, and amortization.
Correct.
So a ratio of 0.6x means that if Ovintiv took every dollar of operating cash they generate in a year, it would take them barely over half a year, just over 6 months, to completely pay off every cent of their net debt.
That is a perfect translation.
Yeah.
To frame it for a household budget, imagine having a mortgage, but the entire remaining balance of your mortgage is only 60% of your annual salary.
Wow, you wouldn't be losing a single second of sleep over those monthly payments. You'd have massive amounts of discretionary income.
Exactly. Because their leverage ratio is microscopic at 0.6x, they aren't trapped servicing bankers. They have the luxury of funneling their surplus cash straight to the equity holders. Returning 63% of free cash flow shows an unbelievable level of internal confidence in their operations.
But, financial engineering, asset swaps, buybacks, they're all brilliant on paper, but if their drills are just hitting dry rock out in the field, this whole financial house of cards completely collapses.
It goes to zero, yeah.
So we have to talk about what is actually happening in the dirt to make these numbers a reality.
And that physical execution in the field is what management is calling their secret sauce. CEO Brendan McCracken attributes their industry-leading performance to this concept he calls a stacked innovation approach.
Let's look at the Permian Basin for a second. It spans West Texas and New Mexico, and it is effectively the engine of the entire U.S. shale industry. In the Permian, Ovintiv's production is averaging 231,000 barrels of oil equivalent a day, and 78% of that is liquids.
Oil and condensate, yeah, which carry by far the highest profit margins. But the most critical technical concept in this entire earnings report, the thing that really makes this whole machine work, is a specific claim they make in their slide deck.
About well degradation.
Yes. They state they are, and this is a direct quote, defying the industry trend of well degradation. They boast a plus 3% base outperformance compared to their Midland peers, and they use this very specific phrase, shallowing base declines.
Okay, we definitely need to pause here and talk about the physical mechanics of a shale well for you, because this is crucial. I used to think of extracting oil kind of like squeezing a lemon. You squeeze it, you get the juice, and eventually you just run out of juice.
Which makes sense intuitively, but it doesn't really capture the subterranean physics of a shale well.
Right. It's actually a lot more like a shaken bottle of soda. When you tap a new shale well, you are piercing this highly pressurized underground formation. It's literally like popping the cap on that hot soda. The pressure just violently forces the liquid out.
And that's your massive initial production. That initial burst is fantastic for early cash flow. But once that pressure bleeds off, once all the carbonation escapes, so to speak, you have to work exponentially harder to coax the remaining liquid out of the rock.
And in the shale industry, those wells typically have brutal decline curves. I mean, you get a flood of oil in year 1, and then production just drops off a cliff in years 2 and 3.
Exactly. And that steep decline curve forces producers onto this really expensive treadmill. They have to constantly drill new wells just to replace the production they're losing from last year's wells.
Because those old wells are losing pressure.
Right. So shallowing the base decline is essentially the holy grail for an oil producer. It means finding a way to keep that subterranean pressure active for much longer, turning that steep drop-off into a gentle, steady slope over years 2, 3, and 4.
And if you can shallow the decline, you completely change the economics of the entire business. You don't have to drill as frantically just to stand still. But how exactly does this stacked innovation achieve that? I mean, what are they physically doing differently down there to hold the pressure steady?
Well, stacked innovation isn't just one proprietary magic bullet, right? It's the compounding mathematical effect of dozens of marginal gains.
Okay, give me an example.
Mechanically, it starts with the drill bits. They are using highly customized bits designed to cut through specific rock strata faster and with way more precision, which reduces the time a rig actually sits on a location.
So they get the hole dug cheaper and faster.
Exactly.
But what happens during the completion phase, the actual fracking?
Right, so fracking involves pumping a cocktail of water and sand into the well to crack the rock and release the oil. And that sand is called proppant. Its literal job is to prop open the microscopic fissures in the rock so the oil can flow out.
Hence the name proppant.
Yeah, and Ovintiv is optimizing the exact volume of fluid and the specific geometry of how that sand is distributed underground. Better proppant placement means those subterranean fractures stay open longer.
Which allows the pressure to bleed off slowly rather than all at once, like engineering a much better release valve for this shaken soda bottle.
That's a great way to look at it. And beyond the fracking fluids, they're also tweaking the physical spacing between the wells on the surface.
I was reading about that. Why does well spacing matter so much?
It's critical, because if you drill 2 wells too close together, they compete for the exact same underground pressure. The industry calls it parent-child well interference, or fracture hits. Basically, one well steals the energy from the other, and they both underperform.
So they're adjusting the spacing on the surface.
Yeah, by mere feet in some cases. By adjusting the spacing and altering the exact sequence in which they stimulate the wells, they effectively eliminate that interference.
So if you improve your drilling speed by 2% and you improve your proppant placement efficiency by 2% and your well spacing yields 2% more pressure retention, I mean, those don't just add up.
No, they multiply, they compound. And the numbers back this up definitively in the report. They state they have organically replaced their full year 2026 drilling locations with 0 increase to activity.
0 increase, meaning they aren't running more rigs, they aren't spending more capital.
Exactly. They are fully replacing their inventory purely through these compounding field efficiencies.
And if you don't have to spend a fortune running on the drilling treadmill to replace degrading wells, you generate massive amounts of surplus cash.
Right.
So the stacked innovation happening miles underground in the Permian dirt directly translates into the $345 million of stock buybacks happening in the market today.
It's a brilliantly integrated strategy. I mean, think about it. The portfolio swaps optimized their inventory for the best possible rock.
Yep.
Retiring the Anadarko debt wiped out all that debt interest expense.
Right.
And then the engineering teams, shallowing the decline curves, maximized the cash flow from that premium rock. Every single move management makes supports and funds the next move.
It is an absolute masterclass in capital discipline. But, before we wrap up, looking past just this single quarter's numbers, what is the macro implication of this technology?
Zooming out from just Ovintiv, this whole concept of shallowing base declines raises an incredible geopolitical question.
How so?
Well, for years, analysts have been warning about peak oil supply, this looming cliff where the global industry simply won't be able to extract enough oil from existing shale plays to meet demand, specifically because the wells degrade too fast.
Right. The assumption has always been that the treadmill eventually breaks down because you just run out of premium spots to drill.
Exactly.
Mm.
But if companies like Ovintiv are proving that you can actually reverse that degradation trend, that through compounding technological tweaks, you can extract significantly more oil from existing older locations, what does that mean for long-term global supply?
It changes everything.
It does. If the wider industry adopts these exact mechanical innovations in proppant placement and well spacing, could that dreaded supply cliff be pushed back decades further than analysts currently predict?
I mean, that completely rewrites the timeline of the global energy transition. If the existing shale formations hold vastly more recoverable pressure than we ever thought possible, the macro supply and demand math has to be entirely reevaluated.
It's a profound realization, and it all starts with just, tweaking the drill bits and managing the sand.
A fascinating concept to leave you with today. The industrial machine isn't just running better, they are basically redesigning the physics of the assembly line altogether. Make sure you follow the deep dive for our daily earnings coverage because we're going to keep unpacking exactly how these companies are engineering their way to these massive cash flows. Keep questioning the gravity of the markets, and we'll see you next time.